Have you ever wondered if your house, shop, office, or land could help you arrange a large amount of money without selling it? What if you need funds for expanding your business, paying for higher education, medical treatment, home renovation, or even consolidating expensive debts? Many people immediately think about taking a personal loan, but personal loans often come with high interest rates and lower borrowing limits. There is another option that many homeowners don't fully understand: loan against property, also known as LAP. A loan against property allows you to borrow money by using your residential, commercial, or sometimes even industrial property as collateral, while you continue to own and use the property. But how does it actually work? How much loan can you get? Who is eligible? What documents are required? What happens if you miss EMI payments? And is it better than a personal loan? Stay with us until the end, because today we'll answer all these questions in simple, practical language. Let's begin. What is a loan against property? A loan against property, or LAP, is a secured loan. In simple words, you pledge your property to a bank or financial institution as security, and in return, the lender provides you with a loan. Here's something important to understand. You are not selling your property. You remain the legal owner. You can continue living in your home, operating your business from the property, or renting it out if applicable. The lender only keeps a legal charge on the property until the loan is fully repaid. Once the loan is cleared, the charge is removed, and your property remains completely yours. Why do people take a loan against property? People use LAP for many financial needs. Some common purposes include expanding a business, purchasing machinery, working capital, paying children's education fees, medical emergencies, wedding expenses, home renovation, debt consolidation, professional practice, expansion, investment in business. Unlike home loans, loan against property generally offers flexibility regarding how the money can be used. However, lenders may restrict using LAP funds for speculative activities like stock market trading or illegal purposes. How does loan against property work? Let's understand with an example. Imagine you own a house worth Rs 1 crore. A bank usually does not lend the full property value. Instead, it calculates something called the loan-to-value ratio, or LTV. Most lenders finance around 50% to 75% of the property's market value, depending on regulations, property type, location, and the borrower's profile. So if your property is valued at Rs 1 crore and the lender approves a 70% LTV, you may be eligible for a loan of around Rs 70 lakh. After approval, your property documents are verified. The property is legally evaluated. Technical inspection is completed. The loan is sanctioned. Money is transferred to your bank account. Then you repay the loan through monthly EMIs. What types of properties can be used? Different lenders accept different property types. These may include A. Residential property, independent house, apartment, villa, commercial property, office, shop, showroom, industrial property. Some lenders also finance industrial buildings, vacant land. Some lenders may accept certain plots, while others may not. Eligibility depends on lender policies and applicable regulations. Who can apply? Generally, the following individuals can apply: salaried employees, self-employed professionals, business owners, traders, manufacturers, doctors, chartered accountants, architects, consultants, partnership firms, companies. Applicants usually need stable income and repayment capacity. Eligibility criteria. Although requirements vary among lenders, common factors include age requirements, stable income, good repayment history, acceptable credit score, clear property ownership, legally approved property. Sufficient repayment capacity, a stronger financial profile often improves approval chances. Documents required. Most lenders ask for KATE, identity, proof, Aadhaar passport, driving license, voter ID, address, proof utility, bill, passport, Aadhaar, income, proof, for salaried applicants, salary slips, bank statements. Form 16 for self-employed applicants, income tax returns, profit and loss statements, balance sheet, GST documents if applicable, property documents, sale deed, title documents, tax receipts, approved building plan occupancy certificate. Where applicable, additional documents may be requested depending on the lender. How is property valued? Many people assume banks simply accept the property's purchase price. That's not how it works. Banks appoint professional valuers. They assess current market value, property location, building condition, age of construction, legal approvals, future resale value. Based on this assessment, the eligible loan amount is determined. Interest rates? Interest rates depend on several factors, including credit score, income, property quality, loan amount, loan tenure, lender policies, market conditions. Since LAP is secured by property, interest rates are generally lower than personal loans. Loan tenure. One major advantage is the longer repayment period. Many lenders offer repayment tenures that can extend up to 15 to 20 years, depending on eligibility and lender policies. Longer tenure usually means lower monthly EMIs. However, remember that longer repayment also increases the total interest they paid over time. EMI example, let's take a simple example. Suppose you borrow Rs 30 CE lakh loan tenure, 15 years interest rate based on the lender's prevailing rate. Your EMI will depend on Rs interest rate loan amount tenure. You can estimate your EMI using an online loan against property EMI calculator before applying. This helps you choose an affordable repayment plan. Advantages of loan against property. Let's look at the biggest benefits. Lower interest rates, usually cheaper than unsecured personal loans. Higher loan amount. You may be eligible for significantly larger funding compared to personal loans. Longer repayment extended tenure helps reduce EMI burden. Continue using the property. You don't lose ownership or possession during repayment. Flexible usage funds can be used for many genuine personal or business needs, subject to lender terms. Disadvantages. You should know. No loan is perfect. Here are some risks. Property is collateral. If EMIs are not paid for a prolonged period, the lender may initiate legal recovery proceedings, which could ultimately lead to the sale of the property as permitted by law. Processing takes time. Legal verification, technical inspection, and valuation can make the approval process longer than unsecured loans. Additional charges. You may need to pay SARA, processing fees, legal charges, valuation charges, documentation fees, applicable taxes. Always review the complete cost before signing. Can you get tax benefits? This depends on how the loan is used. For example, tax treatment may differ if the borrowed amount is used for business purposes, property-related expenses, or other eligible uses. Tax laws vary and may change over time. Consult a qualified tax professional to understand your specific eligibility. What happens if you default? This is extremely important. If you miss a few EMIs, the lender usually charges late payment fees and may report the delay to credit bureaus. If the default continues, the lender can begin recovery proceedings according to applicable laws and the loan agreement. In severe cases, the pledged property may be auctioned to recover outstanding dues. So borrow only an amount that you can comfortably repay. Tips before applying. Here are some smart tips. Compare multiple lenders. Check the annual percentage rate, APR, and all charges. Read the loan agreement carefully. Maintain a healthy credit score. Borrow only what you actually need. Choose an EMI that fits your monthly budget. Keep all property documents updated. Loan against property versus personal loan. Let's compare. Loan against property. Secured loan. Lower interest rates. Higher borrowing limit. Longer repayment period requires property as collateral. Personal loan. Unsecured loan. Faster approval. Higher interest rates. Smaller loan amounts. Shorter repayment tenure. If you need a substantial amount and own eligible property, LAP can often be a more economical option than a personal loan. Common mistakes to avoid. Many borrowers make avoidable mistakes. Borrowing more than needed, ignoring processing charges, not comparing lenders, missing EMI payments, overestimating future income, signing documents without reading the terms. Avoiding these mistakes can save you money and stress. A loan against property can be a powerful financial tool when used wisely. It allows you to unlock the value of your property without selling it, while often offering larger loan amounts, competitive interest rates, and longer repayment periods than unsecured loans. However, because your property serves as collateral, it also carries significant responsibility. Before applying, compare lenders, understand every fee and condition, evaluate your repayment capacity, and borrow only what you truly need. Used responsibly, a loan against property can help you achieve important personal or business goals while protecting your long-term financial health. If you found this guide helpful, don't forget to like this video, subscribe to the channel, and press the bell icon so you never miss our latest videos on loans, personal finance, banking, and smart money management. If you have any questions about loan against property, leave them in the comments below. We'd be happy to help. Thank you for watching, and we'll see you in the next video.